After Fed Chair Powell's latest commentary, markets took it as a somewhat dovish interpretation following his latest comments. In turn, the S&P 500 rallied further, closing as much as 3% higher, the Nasdaq 100 up over 4.5%, and now with the S&P 500 up 17% from its October low, I guess the question that many people will be asking, is the bear market over? Hello and welcome to the Capital.com YouTube channel. My name is Justin McQueen. Before we get into it, if you can like the video, that would be greatly appreciated. And also if you want to add to the debate or perhaps maybe even suggest an asset to potentially look at, then put your comments in the comment section and we can respond to those. And also perhaps do a video if you have any assets that you'd like us to look at. If you haven't already, please do subscribe up to the channel and click that notification bell if you want to be notified on our latest videos on the channel. Now, in terms of today's video, I thought it would probably be best to do a bit of a recap in terms of what was said by Fed Chair Powell, particularly given the market reaction, and also look into the ramifications as to what might happen going forward and some of the key factors to watch. Now, in terms of a Powell speech, of course, really it's been somewhat of a reiteration of what he had said previously at the November press conference. He essentially more or less confirmed that the Federal Reserve will most likely go ahead with a 50 basis point rate rise relative to 75 basis points. And as such, markets had slightly unwound those hawkish bets or those bets for a 75 basis point rate hike, which in turn fueled the rally in equity markets, bonds, and also added to the downside in the dollar index. Now, elsewhere, he did also reiterate that while they'll likely slow the pace of rate hikes, the terminal rate, the peak interest rate, will be somewhat higher than what they had initially projected at the September meeting in terms of their staff economic projections. A reminder, they will update these projections at the December meeting, so that will be one of the main focal points to watch out for, not just the fact that they'll hike by 50 basis points. I think that's pretty much confirmed. Markets are fully priced for this, so that's not where the surprise will come in. The surprise will come in terms of their commentary and those staff economic projections and how they compare with regards to their September ones, and whether they state that, well, at peak interest rates will hold that longer than what the markets currently expect. Keep in mind, markets are pricing in some rate cuts at the second half of 2023. So if we see some pushback on that, then that will be particularly important at that December meeting. Now, elsewhere, Powell did also state that substantial progress had been made towards getting rates to restrictive policy, but did add that there was more ground to cover. Now, that's slightly different to what he did say at the initial aftermath of the November meeting, where he said there was still ways to go before they even get rates to the restrictive policy. So that slight dovish nuance there, I guess some people might be looking at and suggesting that, well, this is slightly a bit more dovish relative to what he had said previously, and hence that gave many the sort of optimism to continue with this move and this upside that we saw in equity markets. So those are pretty much the main comments out of the press conference. As I said, largely a reiteration, not too many sort of surprises there. And I suspect maybe the surprise might be in the fact that he didn't exactly push against the rally that we've seen in equity markets and the move lower that we've seen in bond yields. And in fact, this easing of financial conditions is perhaps maybe more justified by Powell, given some of the data points that we have seen. Now, moving on to the data points, probably one of the main data points that we've seen over the last 24 hours was the Chicago PMI, which crashed down to 37.2, which was against expectations of 47. Now, each time the Chicago PMI has fallen below 40, that has pretty much coincided with a recession over the last 55 years. So 100% strike rate there, in terms of suggesting that the US economy will be falling into a recession. And for me, that's pretty hard to go against, to suggest that there won't be a recession. Alongside this, other reliable indicators also indicate that there will be a recession in the US. Firstly, the US yield curve. The 2-10 curve is now the deepest inverted since 1981. And we also have the perhaps more timely 3-month to 10-year yield curve, which is also deeply inverted as well. But of course, yield curve inversions, yes, they do forecast a recession. It's 100% strike rate over the last 50 years. The problem is the lag. That's ranged from a couple of months to a year or two. So it's hard to really get the timing right as to when a recession will exactly take place. And many people do look at the 3-month relative to the 10-year on the basis that it perhaps has the lag is smaller relative to the 2s10s curve. So that's something to keep in mind. Elsewhere that's also fueled this rally has been China. The reopening trade that many people had been optimistic about a couple of weeks ago has been somewhat vindicated by the fact that we saw from the Chinese vice premier, who's also the COVID chief, state that people who are positive, they can isolate at home as opposed to going to a community centre to isolate. And that's quite a significant shift from China in order to sort of deviate away from zero COVID policy. At the same time, the Vice Premier also stated that the weaker effects of the Omicron variant does call for a slight reassessment of China's current policy. So again, another subtle shift there that they could be soon looking to deviate away from zero COVID policy. And these are two anchors that had been very supportive of the dollar. For example, the zero COVID policy, the stop-start Chinese economy, and also the sort of autopilot hawkish Federal Reserve have been two key pillars for support for the dollar. We've had those both unwind over the past couple of weeks, and therefore the dollar has come back quite aggressively, testing its 200 DMA. Meanwhile, the S&P 500 has finally broken and closed above its 200 DMA. And at the same time, the euro has also made a sort of a firm move above its 200 DMA as well, and actually closing above it. So again, key technical areas have been breached in some of these major markets. Now, in terms of some of the levels to look out for, on the top side for the S&P 500, 4080, which is where we're currently tested now, where it's the trendline resistance from the peak, the 4120, which is the September highs, and I think it was just before the release of the CPI data. So again, somewhat of a significant level, and then just above there, 4179, which is the 55-week moving average. Now on the downside, the 200 DMA, which had been significant resistance, capping the rallies in the summer months, is now acting as support at 4050. Then below there, we do have 3920, where the 100 DMA roughly resides, and then the psychological 3900 area to watch out for. So those are some of the key levels to watch out regarding the S&P 500, but I'll just show you on the chart as to where those areas are particularly, and also the general outlook for the equity market. So as we can see here on the chart, we had a sizable move yesterday. The S&P 500 closing up 3%, facing a little bit of resistance at this descending trend line from the all-time high. And again, this is coming back in the August month. We see a break and a close above, then that would give us further room to expect to move higher towards 4120 and then around 4179, where the 55-week moving average does reside. So a couple of key areas to watch. Of course, we do have some notable data points to watch out for: the non-farm payrolls on Friday, and of course the US CPI before the December meeting. And if those both those readings were to be lower than expected, then I suspect we could probably have a move to that 55 DMA and 4200 on the top side, given the fact that that would further reduce expectations of tightening going forward. As a reminder, markets are currently pricing in a 50 basis point hike at the December meeting, followed by 225 basis point rate rises. So therefore, lower than expected readings. We could therefore see perhaps the second 25 basis point hike start to be priced out. So that's something to consider when looking at the S&P 500 as well. The markets currently seem to trade bad news or bad economic data as good news for the price. That's generally what the market reaction has been. Now, I'm slightly a little bit against that view, given the fact that the Federal Reserve won't be as quick to look at cutting interest rates, given how inflation still remains pretty high relative to the central bank's target. But that's what we're seeing currently at the moment. So therefore, markets will continue to persist with that view. As I mentioned, support-wise, really key around sort of in between, I'd say about 39.40 to 39.20. We've seen multiple tests at this sort of area, failed to really sort of close below 39.20. And we did have a little bit of a test at 3900 exactly. But again, that'll be sort of your key area to watch out on the downside for the S&P 500. So there we have it with regards to the S&P 500 outlook. In terms of it being the end of the bear market, for me, it's hard to say, given the fact that a lot of recession indicators are suggesting that we are moving in that direction. And I also think that the Federal Reserve will probably be a bit slower to act in terms of cutting interest rates or slowing down or moving towards quantitative easing. I don't see that happening anytime soon. However, though, we are breaking some key technical areas. The 200 DMA was quite significant for the S&P 500, so you have to respect those. Perhaps maybe it might be a bit more prudent to move to a neutral bias on the equity market, particularly as also China are moving away from their sort of stop-start COVID policy and moving towards reopening the economy. So a couple of key factors that have plagued the markets for the majority of 2022 are starting to unwind as we head towards 2023.